All right, I'm going to hit share screen and I'm going to say, okay, you can see me? Good. Where is the new normal? I feel very unsettled these days. The news is very confusing. I wrote in my my promotion that we've got talk of a bubble, runaway housing costs, Fed tightening, end of the stimulus. We had a show a couple weeks ago about the millennials and the impact of the millennials all trying to buy houses and start families at the same time. We have record low unemployment, but not so much in New York. We've got a lot going on, and now perhaps we've got a world war. So with that, I wanted to find out from the top appraiser in New York, the best guy there is for figuring out what is the price supposed to be, what's the real value of something. And I wanted to ask him, where is the new normal? So our guest today is Jonathan Miller, founder of Miller Samuel Inc. And I think you've been doing that since what, 1986, according to your biography. And so you've probably learned a thing or two about pricing, and that's why we wanted to ask you on the show. So welcome to Boroughs and Burbs, the 50th episode.
Oh, is it really?
And
yes.
Welcome Roberto, my partner, and Scott Hobbs, my partner. And glad to have you with us.
Congratulations. That's a lot of podcasts.
And you're the man, number 50.
Yeah.
Number 50. So I heard about an hour ago from somebody, from a fellow realtor, Modern Houseman. Maybe some of you know him, but that he goes by Modern Houseman. And he said, you can't fight the Fed. And I thought, wait a minute. You can't fight the Fed. Is the Fed really the biggest influence among all the things I just listed? So I figure I might start with that, Jonathan Miller. If all we heard yesterday, the top story after Roe v. Wade, was that the Fed tightened exactly as much as we expected them to tighten, and I just didn't think that was the biggest news.
Well, in my mind, the way to think about the Fed increase is, at least the way I think about it, is that they were about a year late. In my mind, that rates were too low for too long. Listen, I think rates were just barely or just short of 5% in 2018 on a 30-year fixed, and rates, the Fed tried to raise rates, at that point, and then once they hit 5%, they had to retract because of the trade war with China that was going on, or potential trade war. And then when we had COVID, doubled down, rates fell even further, in the mid to upper 2% range, which was sort of insane. And really the economy, the quarter, during and into the lockdown was where the vast majority of economic damage, if you look at really what happened after that, economy was just on an upward trajectory, at least for home buyers. One thing, I can't remember if I mentioned this last time we spoke, but the pandemic was punishing the lower wage earners who tend to be renters or entry-level buyers, and it was much more nominal damage to mid and upper tier salary types, and many of who had some of their best years, income ever. And so across the US.
Also true now of interest rates that they are having, and with respect to pricing, we're going to get right to the heart of this, is the rise in interest rates having a disproportionately high effect on the low and middle tiers of the market.
Absolutely.
And less of an effect on the higher end of the market.
The point I was building to is that what happened is because of, in my opinion, that rates were disproportionately low for the state of the economy. They're sort of stuck at an unusually low level. it basically brings this premise of mine. I meant like a couple of weeks ago to write a post about this, but I've been too busy. But that low rates make housing less affordable as a concept. You know, it makes your brain crack a little bit. But essentially the way to think of it is low rates have obliterated supply. And the reason for that is there's disproportional demand, or the demand is moving much faster than inventory can replenish itself. And forget new development, you know, in any part of the country or the region, it's 10 to 15% of total supply. You know, maybe a little bit more, a little bit less, but that, you know, it's, if you just remove that and, you know, or you could say, well, if we tripled how much we build, it still wouldn't be enough, right? So I'll take an example. Like I live in Connecticut, and one of the market that I live in normally has 200 listings, you know, pre-pandemic. The year after the pandemic, it had 50. Now it has 12, right? And this is the narrative in, you know, Douglas Elliman's, I cover like 40 housing markets for them across the US. And it's the same narrative. The exception to that is really Manhattan. Not to say that the market isn't moving fast, but there's actually, inventory is not wildly low at all, because it was late to the party. It started 6 or 9 months or more after the suburbs did because of COVID. You know, the vaccine adoption is what allowed the market to wake up in early 2021, and then was interrupted by Delta and Omicron.
Was late to the party seems to suggest that Manhattan, New York is just lagging the market, that they're going to experience the same lack of supply. They just haven't arrived yet.
So that would be the case if mortgage rates weren't elevated, right? So I think the way to think of it is, listen, Manhattan is first quarter report, we were 47% cash, 47 and change, let's call it 48% cash. So the impact, financing's impact is somewhat muted, but it is not, you know, that does not make the market insulated. It just makes it less direct, sort of hand to mouth impacted, but it's, and it's even less of a factor when you consider the heavy lifting in terms of transactional volume is skewed, you know, upper half, you know, to mid to upper half of the market versus the entry level.
Jonathan, when you talk New York, you're not just talking Manhattan, right? You're talking about
New York City.
Reflects that also.
I'm sorry, I'll be more specific. Yeah, New York City, mostly Manhattan is the one that saw the most lag in sort of getting going. Brooklyn, Queens, the outer boroughs were more like a hybrid between the insanity of the suburbs and the lag in Manhattan. They're somewhere in between. I mean, housing prices in Brooklyn since 2018, every quarter, it's been either the first, second, or third highest median sale price in history. You know, and sales activity has been elevated. And inventory, while there hasn't been this complete depletion in the city like you have in the suburbs, they're very different markets in general. The city has more supply, so brokers that represent properties in the city have more competition. In the suburbs, I'll talk out of school for a second. I'm supposed to, in my mind, I feel like my responsibility is to be the voice of reason when it comes to sort of housing market conditions. And my wife and I bid on a property in upstate Connecticut, 6-way bidding war, 28% above the asking price. And we lost. We were the highest, but we weren't all cash.
You're supposed to be the expert. And when your wife says 28%, that's the number.
Well, the deeper dive is that the deeper dive is that the house is underpriced a fair amount because it was an odd property, but it was wasn't odd for us. And they underpriced. So if they priced it the way I thought it was worth, we only overpaid by 15%.
That was strategically done by them?
I didn't have the benefit of, I don't know. It doesn't seem like it. It's a really hard property to price, but I was pretty confident it was underpriced. But this is what I'm being told anecdotally, is that from the brokers in this area, is that the properties where there's a bidding war, roughly half of the winners walk away eventually, that they're caught up in the moment, and then the second in position gets the property. So we're hanging, we're holding out, we're still looking, but it's just like how, and so to John's earlier point, like, what is normal? Well, right now that's normal. Like, I feel like normal is a condition that's existing for 6 months. And right now we're in a world where every day is a new outrage, a new concern, a new shock. And so it's not like, hey, everything's the same for 5 years. Like, we've had periods like that. It's much more volatile. And that's the challenge.
It's interesting because that is what's happening here. People get caught up in the frenzy, and when I represent properties that I have, for example, I know that at the open house, we're going to have 40 people and we're going to have 6 offers or whatever the case may be. I always usually say I'm having an open house on Sunday, but we are also scheduling an open house for the following Sunday. Yeah. So we want you to take your time, and we want you to really methodically think about the offer you're going to make. So don't just make me an offer tonight. Think about
it. And that makes so much sense. And so one of the things that we're seeing in the suburbs versus the city. So for example, bidding more market share in Manhattan in the first quarter was a little over 9%, meaning 9% of the closings in the first quarter sold above the last asking price. That is not a record. The record was 31% in 2015. Its elevated norm is 5 to 7%, so it's 9%. So it is, it is a risk market, but it's not, the outlying, at least for Westchester, Fairfield, and Long Island, Nassau, Suffolk, bidding war market share is around 50%. The markets I cover for Element in Southern California are 65%, with some markets submarkets being 90%. But sales in our new signed contracts report are showing the sales are falling in these markets. Well, they're falling because there's not product.
There's nothing to sell, right?
And the evidence, and so you can say, oh, well, it's coming, the demand isn't there, that's why sales are falling. No, when you have record market share bidding wars, that's telling you that the demand is still extremely elevated. I think the way to think of the short term, meaning, I think this is going to be a really busy spring for Manhattan. It might be less of a frenzy than we saw because of the big, jump in rates. But frankly, I don't think it's going to have a dramatic input. I think the longer term, meaning 6-12 months down the road, I think volume slows somewhat, but unless we go into a recession, the economy is pretty robust. And to take it sort of to a super macro, put aside commission thinking and all that, volume, just think about rising rates are like the best thing that could have happened to this housing market. And the reason why I think that is because it is not, to use the word normal, it is not a normal, sustainable condition to have 50% market share bidding wars. That, as we know, can end badly, right?
I'm surprised that both you and Roberto's market report both talk about rates as being such a big influence. You just said the giant rise in rates, but they're still relatively low. Versus
it doesn't matter. Everybody has short-term buyer. Yeah. Everybody, the media cycle, people have a short-term memory. When you start saying, back when I walked barefoot in the snow to school, I had it so much harder. 2 houses ago, I paid 8.25% for a 30-year fixed. The rates just collapsed from 13%. It was like free money, right? Nobody cares about that. Like, it's sort of the you're absolutely right. 5% is where it should be. That's a great, I think it should be in the 5s, but think of it in another way. Think of it as these higher rates, they're rising because the economy is good. The concern is that the Fed is always kind of late, like they were late to raise, so they'll probably be late to drop. So there's higher odds of a recession. And today, even, Powell didn't remove the possibility of a future increase of 0.75%.
So you do think that the Fed's actions will have a chilling effect on the market?
Not chilling. Chilling is highly negative. I think what it does is it's like it's like the bumpers in, when kids go bowling and they hide the gutter. It's kind of like it's putting sort of training wheels or something to
putting guardrails on it. It's moderating.
Guardrails, that's the word. That's
okay. The word. Moderating.
Yeah, I was thinking of
chilling.
What analogy can I come up with? And I'm thinking of bumper, for gutters for bowling.
I said chilling for a reason. I meant to say chilling, and you're like, oh yeah, that's too strong a word. If COVID, supply chain problems, and Fed actions, and a world war don't have an effect of chilling the market, what will?
So, but the thing that I've learned over time is that so first of all, consumers obsess too much about rates. They're marketed that way. It's sort of like, it means something and it doesn't really mean that much to your payment if it drops 0.02% and you want to lock in at that number. I'm just being more philosophical, saying that, if you want a relatively robust or, strong housing market for an extended period of time, you have to have higher rates. And that's why you had the bidding war. So that's that.
But my client in a bank is saying, do I put the house on the market this year or next year? And they want to know whether the Fed and all this bad news means they're going to lose their window.
Well, first of all, the Fed raising rates is good news in the context of the economy, right? It's them trying to cool it off from overheating. So that would tell me that housing prices aren't going to be, they're not going to be down next year relative to what's happening now for a couple of reasons. One is, the example I gave about, my housing market has 12 listings. So if it increased 5-fold, it's still wildly low. So there's really a firm underpinning under prices. This isn't a high leverage market. Banks are generally, underwriting is much more conservative than typical levels. A year ago, it was about 20% tighter. Banks are 20% tighter than pre-housing bubble. It's a million times tighter than the housing bubble because you just need a pulse, fog and mirror, and all that sort of analogies that have all been overused. But this is not a leveraged boom. This is a cash / low LTV relative to historic standards kind of boom. And so the downside for this is, in the words I think we look at or talk about on the other side of this, is plateauing, moving sideways, as opposed to correction. That would be my guess, at least at this point.
Jonathan, don't you feel that Manhattan being an anomaly to everywhere else in the country, like you're seeing in Connecticut and other places, you're seeing prices spike. Here, right. There's just a methodical rise,
Yeah, it's not.
and appreciation, so that's such a healthy place to be, right? Like, I don't see that.
Yeah,
I
I
don't
think
see.
the way I would describe it is that prices in the boroughs of Manhattan have been flirting with records, or, so they're not necessarily rising dramatically. They're just they're elevated and, either hitting a record or close to it, or, as opposed to like, they're 30% below and they're climbing back. Whereas the suburbs are up 20%. I mean, many of the markets nationally, depending on the sources, the numbers are like 16 to 22% up annually for prices. And, obviously wages didn't rise that much.
I'm going to show a chart while you're talking, but this is the chart, and you see that New York is one of the few places that's not red hot, overvalued.
Right, right. Absolutely. And the reason for it is that it was late to the party. That the dollars flowing through Manhattan are, even as busy as it is, it pales in comparison to what we're seeing everywhere else. And so it's a more moderate boom than a full out frenzy that we're seeing in other housing markets. And so, for example, all those, investment banks and, national banks that forecast or last year predicted 20% rate increases, price increases, give or take. And they were pretty darn accurate. Next year, it's 5 to 10%. And then the year after that is 5%.
Jonathan, were the other urban centers like San Francisco, Chicago, Atlanta, these bigger cities, were they affected as much as New York? Because it's all, New York got really hit hard, but I don't hear as much about those other bigger cities where people just completely left.
So they're absolutely urban markets. So there's this fascinating thing. I haven't looked at it in a while, about a year ago, but there was a Fed study put out by the Cleveland Fed, actually using the New York Fed's data, and joined forces with them, and they found that all the urban markets saw a decline in temporary or permanent or whatever you want to call it, decline of population, and now they're all seeing it, at least a lot of it come back. Doesn't mean it all comes back.
Yeah.
But it was sort of an overreaction to a certain, it was lack of information or education in the beginning of the pandemic, when there was no vaccine and, no one knew anything.
No one knew what it was. We didn't have, no one had gloves, no one had masks, no one had anything. Now, even if something were to come, we'd be like, we know how to dress up for it and go.
Correct. That's why there won't be a lockdown, another lockdown. Aside from just political resistance and people just have had enough, we're better prepared to how to handle it. There's all kinds of medicine coming in the pipeline, so it's very optimistic in that regard. But, like John was saying, by the way, just for the record, my wife and I should say, raised 3 millennials and 1 Gen Z. And all my millennials, they're young millennials. I mean, they're young millennials on the young side of the spectrum, all bought houses in the last couple of years in the suburbs. And the Gen Z is renting an apartment in Manhattan. I don't know if I can ever get him out. He loves the city. Like, he doesn't, and he's a reverse commuter. He works in Connecticut.
Wow.
And his wife, or his not wife, his girlfriend, Freudian slip there, works in the city and loves it and loves all the social. So the reason why I bring this up, this is more sort of just something that I've been thinking about, is that I think pre-pandemic, we overweighted the reason why people were in the city. It was like 90% driven by employment, work, being in the city, access to work. Now what we're learning, and remember that just Manhattan alone, the first quarter had the most sales in the 33 years I've been tracking. The for a first quarter, I should say. The fourth quarter of last year had the most sales for a fourth quarter since 1989, since I've been tracking it. And the third quarter of last year had this most sales of all quarters since 1989. So you look at that, and the office towers in Midtown are 2/3 empty still. They're slowly, as a snail, climbing, but it's still like just under 40%. And yet transaction volume is at all-time highs. And I think the reason for that is that, remote sort of changed the equation. And so there's a lot of people living in the city that don't work in the city. And the stereotype.
You advise your 3 millennials and your Gen Zer, and they say, Dad, am I overpaying? Is this, are we going into a recession? Is this a risky proposition? You're saying, you know what? I feel pretty good about the next 5 years, 10 years, your value proposition, both in the
First of all, you're assuming that my
city.
sons listen to me. It's, a lot of it's buzz off, old man. But we talked and strategized, and like my one son just won by, sheer luck. He preempted a bidding war. We all three, we talked about it, my wife and I, a lot. And I had first of all, I didn't see this as a bubble at all. I see this as, it's definitely a frothy condition, but I guess what I look at is, so the big difference between today and say 2004, a few years leading before the sort of Case-Shiller peaked in the summer of 2006, if you want to use that as a marker for prices. Sales in the bubble peaked in 2005. You look at those periods when the music stopped and sales activity turned off, inventory was at record highs, and it was at record highs, but we didn't see it because sales are rising faster than inventory was growing. So the market felt blistering, but inventory was, and then once the music stopped, there was a huge pile of supply sitting there. We don't have that in this cycle anywhere in the country. Every market, I'm saying in the country, but I feel like, at least the markets, cover for Element and then consulting I'm doing around the country. Inventory is obliterated. So let me give you, that show where it says, like you think you're smarter than a fifth grader or whatever. So this is how I would describe inventory on that show. What is inventory? I started talking about it, and I'm a very nonlinear person. I went off on another tangent. But when you think about inventory, you move new development aside and you just think of supply as resale or existing product. Inventory is this blob. It's this living, breathing organism that is based on the life cycles that people live in it. They trade up, they trade down, they move a different location, they get, they have a growing family. There's like a zillion reasons for why people move. The problem is that rates were too low for too long. And you had people sitting for a year and a half, stewing, thinking about moving, why they hated where they were moving, what the options were. That inventory was obliterated. It wasn't, it was obliterated. And so as we move through this sort of boom, even if inventory rises with higher rates, it has so far to go that this is a very different scenario. I hate those people that say this time it's different, but I must have
So-
to hate myself because it is different.
So I want to key off of what you just said about new development aside. I want to come back to new development but I'm going to pin you down with a number first. Okay. I'm going to go back to that chart.
7. No,
Okay, I'm gonna pin you
that's my
down.
favorite number.
I'm going to pin you down because it says over the coming 12 months, Zillow predicts home prices are poised to spike 14.9%. CoreLogic and Mortgage Bankers Association predict prices will climb 5%. So
Yeah.
my first question is, are you in the more bullish 15% with Zillow, or are you closer to the 5% on a national rising of prices?
I think it's 5 to 10. It's more than CoreLogic, but not that much more. It's hard to be on Team Zillow when they got Zillow offers so wrong. And
Okay.
and
Now,
the reason why I
wait.
say it, so let me just say
I know
one
it's fun
thing.
to
I have
bash
to say,
Zillow, but I want to, I got so many questions for you.
I know,
Look.
but this is important. So just to
Okay.
understand is that okay? So they're in the they're in the sort of forecasting business. What your home is worth today, and so nationally, Zillow is accurate within 2% of what it eventually sells for, but it's only accurate within 2% if the property is actually listed. Right? Because you can see all the lines just move to where the list price is. Hey, that's the estimate, right?
Right.
If it's not listed, it's only accurate within 7%, which is atrocious. So to get from 7 to 2, they need you guys to tell them how much it's worth, which tells you as a general concept that it's garbage. And I think that's, even though they've won the consumer.
So Zillow says 15, you're closer to 10, CoreLogic's at 5.
I'm under 10, but I'm not 5.
Now, how about New York? What does New York do over the next 12?
I would say that it's probably more like CoreLogic or a little bit higher, and not Zillow. And the reason why I say that, even though we saw that in the suburbs,
But you
is I
said they
think-
were lagging the market, and that would
Right,
suggest
which
that
would
they've got more to
imply-
go.
it would apply that they become like Fairfield County. New York City becomes like Fairfield County, where prices go up 15-20%, Westchester, all that, except that in the equation now we have a 0.5 point increase, and then we have probably 2 more 0.5 point increases, and then we have 3 more 1/4 point increases. And so that does take the wind out of the sails. It doesn't make the market terrible. It just slows down the frenzy. That's why I don't think 9 months from now, that Manhattan is going to be like Westchester was, last year.
I don't think we're going to have that because our inventory levels are so high. We have great demand, which is absorbing it. And if anything, it's becoming a very healthy market where people are trading at very fair levels. I think that is going to create appreciation, but it's not going to spike. I just don't see that happening. I think.
Right. Because there's supply. Like, that's
Yeah.
your point. Like, there is inventory. There is. And, it's interesting, the skew towards sort of the upper half of the market because of the economic conditions, that is a little bit exaggerated in the sense that summer 20, when like the high end, the bottom dropped out, the high end after the lockdown. As we look at what's happening today, instead of the high end being the laggard or the bottom of, the lowest price points being the standout, all segments are growing at about the same rate. It's really weird. It's kind of like the market returned back sort of in sync. So relatively, relative to past experience, the high end of the market's doing really well. But in reality, because it had been weak for the preceding 5-7 years, it's doing really well. But in the context of overall market, it's sort of on par with everything else right now.
So I wanted to get back to new development, and I'll defer to Scott Hobbs and let him ask maybe the question. But so if Scott is looking 18 months or his clients are looking 24 months, 3 years out before product actually is finished and on the market, what do you see for the long-term horizon? Those guys are saying, I can withstand another half point, a couple of half point rises. You know, I'm looking long-term. So we just had, I think I see in the chat, we've just had a 10% population increase in the last 15 years. We've increased by 32 million more people in the housing market. Scott's not building them fast enough. He's thinking about building a whole lot more houses, and he's not discouraged by a few half point rate increases. So would you say that this is going to continue for the long term, the 5 to 10 year horizon? We're going to continue to see price appreciation if builders like Scott Hobbs, both in New York and in the suburbs, start investing now in new housing stock?
So I guess the simple answer would be, this is right up there with the meaning of life. It takes a 5-hour answer. So the problem with new construction is, you know, in my earlier quip about, hey, if you doubled or tripled what you're building, right, there still wouldn't be enough. I'm being very simplistic when I say that, because the default, actually default in the housing conversation is probably not the right word. But when we think about what is being built, it skews to the upper half of the market, generally speaking, because of land costs, right? Land, you know, land is what is actually, you know, predominantly here appreciating. It's not the building itself, like in a single family house.
Builders in my market are saying both of what you just said. I'm going to build at the high end of the market, and triple is not enough. I love that quote. Triple, building 3 times as many would still not be enough. And there are some notorious builders here who said, I'll take all the land you could give me, because no matter how fast I build, it won't be enough.
Right. So think about, what does remote really mean, right? Remote is a reflection, like the success of remote, you know, kind of the rule of thumb here is the more affluent you are, more wealth you have, the more mobile you are. And so I think what we're going to see over the next 5 years, as we're really trying to figure out this remote thing, in terms of the linkage between work and home, I think the emphasis is going to be on the high end, but it'll probably take it, you know, and it probably is already taking a little bit of a different form than it did pre-pandemic. But you know, I think I think the mix, at least over the next 5 years, is going to continue. You know, before the pandemic, it was about luxury. I'm not saying that changes. I'm saying it becomes more viable. And then the other sort of outlier, which I haven't given a dramatic or significant amount of thought to, is affordable housing, which really is middle-class housing, is sort of the holy grail of development, if that can be resolved, because remote adds options that weren't there before.
No, because the laws haven't caught up with it. If you're in Connecticut, you know that we have 169 municipalities, and it's not like Darien can use Norwalk's low-income housing or affordable housing, or New Canaan can use Stanford's. Each one is held to its own standard.
Yeah.
So
and if they don't meet it, they don't necessarily get certain federal tax dollars, so they got to do it. But yeah, I know.
All right, I want you to comment on this brilliant piece of writing I discovered this morning. Are you feeling locked in? And I'm gonna let Roberto explain what that means. But in Roberto's market report this morning, he said that people are not moving. There it is. Yeah. Not moving. They're feeling locked into their low mortgage rates and hesitant to move on with their life's needs and decisions. You agree with that?
I do. I think there's a bit of that, but I think one of the big reasons is because you can't find something to buy. Now, remember, I'm thinking of the suburbs and what I just went through. But I think, rates have been so low for so long. That is absolutely a phenomenon where people are sort of married to their rate and they want to stay at the rate. But I don't know how long or how long that sticks around. Sometimes it's a matter of necessity. You can't afford what you really want to make that move anyway.
I literally am experiencing that on several properties where people are they want to upgrade, but one guy was like, I have such a good rate, I just can't. And I said, you're not seeing the forest for the trees. You need to, that it is one element in the grand matrix of what is buying an apartment and what all, I told him, I said, listen, you can buy now for probably a better price than you can buy later. You can refinance later when interest rates come down, but you cannot reprice. So you might as well take those 2 or 3 years for interest rates when they come back to at least begin to build that equity. And it reminds me of, I have so many friends that they had rent stabilized apartments and they had a deal. And because of their deal, they never bought an apartment and started building equity. And they still are in those rent stabilized apartments. And they literally could have accumulated $1, $2, $3 million in equity had they made the change.
Is that in the city or in the suburbs, Roberto?
Here in the city.
And is that a perception that, okay, I could move from my $2 million, I could buy that, I could trade up into that $3 million apartment? Is that also, number one, I have a good rate. 2, I don't believe that $3 million price, do they think it's a bubble? Do they think it's going to come down, or that it'll still be available to them next year?
I think they're just totally focused on what the headlines are, and they're focused on one item. There's so many items, and I think when we're here primarily, we're selling people homes. There's a lot of it. I mean, there are investment properties being bought, but these are people's homes. These are long-term investments. If you're looking at a long-term investment, you have to get on with your life's needs. You need that extra bedroom for that child. Your other kid has gone and now you want to save some money, whatever. You got to get on with your life's needs, because what you're going to do is you're just going to lose out. You can't time everything. You just got to it's like dollar cost averaging. You just got to start investing. And in the long term, you're going to be better off.
See, I desperately need a barn. That's why we're moving. So
what are you going to do?
Add that to your list. Well, we're looking for a house with more land, and I need a barn.
You see,
need a barn.
And he's not going to wait for prices. He's going to get in right now.
You're a fascinating case study. So you want more land in a barn. How much land is enough land these days, Jonathan, for you?
4 or 5 acres.
That's great.
Okay. And a barn. What do you want to do with your barn? You're not putting horses in your barn.
No, late 70s or early 70s, late 60s muscle cars. So that's mine.
Nice.
Okay. And how far from Manhattan would you be willing to go to get 4 acres in a barn?
I'm 60 minutes right now. And since the pandemic, I call it the pandemic era that we're in, I only go into the city twice a week.
So are you willing to go 80 minutes now? 90?
Well, see, I'm on Metro North, and on the train now I work. I write a lot of what you see, like my weekly housing notes.
Are you around Westport right now?
Darien, the Darien, just after Stanford. So we're like...
There's no 4-acre properties left in Darien.
No, that's where I'm living now. I'm looking...
You're going to have to go north, my friend.
Well, that's what I'm doing, because 3 of my kids are a little further north, and we have 2 grandkids that are up there. So we just want to... So right now we're like 40 minutes from like one of my kids bought in Ridgefield.
Okay, so yesterday a bank called me yesterday. This is a true story, and I just want to... We're going to have some fun with this. So, and they said, I've got a house that we've foreclosed on, and as soon as the tenant leaves, we want you to put it out there. And they said, and we're going to say $2 million, 4.5 acres, it's got a little cottage on the property, and it's got a big barn for your cars. But it's in rough shape. So that's the next variable I want to identify to you. The tenant has been kind of, well, apparently that it had some water damage, so they just cut out the sheetrock in the lower level.
Yeah,
left it
foreclosures
that way.
are always,
And it's got some, some leaks in the roof and all that.
yeah.
But are you willing to do work to get a deal? Because Scott Hobbs says that they're paying a premium now not to have to wait to buy it.
Oh yeah, there's a premium for, right now there's a premium for renovated or move in versus, getting that deal. But not as much as you would think, at least in the markets that I'm looking at, because there's nothing, like there's no supply. So you're seeing a sort of a compression between renovated and unrenovated that's narrower, at least in the markets we're looking at, just because.
Explain that. Explain.
But not in Manhattan. Not in Manhattan.
No. This is like
Okay.
Fairfield County,
No,
Connecticut.
both of you
and
explain
Westchester.
that. Where am I seeing compression, and what does that mean? The spread's
So
narrowing?
What he's
what happened-
saying essentially is that there's so little product that people have to consider that. So therefore, there's not the gap. In here in New York, I have a property that it doesn't need a complete gut renovation, but it needs renovation. And I've probably shown it to 14 people, 12. The reason why they're like, I don't want to do the work. 12 of
Right.
14. That's a huge percentage.
On a personal level for us, we started thinking about a move 6 months ago. And so we renovated, we raised 4 boys in our house, 18 years, a lot of wear and tear. We renovated 2 bathrooms, replaced a bunch of windows. My house is 200 years old. So it's already, it has lots of stuff that you have to maintain, but it's in good shape. But it was like endless. And what should have taken 2 months just is finishing probably this, fingers crossed, this Monday. Like, I feel like the contractor is part of the family because I see him, every third day they show up for half a day. And so that's the nature. Like, and then we just, we order like new sliding glass windows. There's 8 panels and we get 7. And you can't find the 8th one anywhere, right? So what do you do? Like, and this is, so the renovation aspect, I understand what, you're saying here is, people don't want that. But I think when the market gets tight enough, I mean, like for me, I don't want a foreclosure. I don't want a fixer-upper. I don't mind if I have to fix, a bathroom or 2 or update the kitchen. But I don't want like something that's like, should be on, one of those reality shows for fixer-upper type things.
Scott,
I want to follow up on that because I happen to run into, any of you who are in Connecticut probably know Itoro's appliances. I ran into Tony Itoro yesterday and I said, how's business? And he said, I've got supply chain problems. And I said, where? And he said, Sub-Zero Wolf can't get Sub-Zero Wolf for like 14 months. And I said, can I get an alternative? And he said, yeah, I can get you Thermador. I can get you to the GE. But for people who got to have Wolf Sub-Zero, they're going to wait a year for those appliances.
Yeah, and also prices too. Like we have this unique sort of thing with a fix with a stove. And to replace it, the stove new was like $1,200 or $1,500. To replace it would be, and this was a couple months ago, it was like $5,000 or $6,000, and no assurance that you'd even get it in 6 months.
Was that a Wolf or Wolf?
No,
range?
I can't remember what we were looking at the time, but it wasn't of that caliber. And literally everything we looked at, because we have a stove without a hood, sort of has the vents pulling in, and it was just wasn't available. And so what do? right? And that this is the, so we had it, like most of the insides replaced, and we could get those parts.
Maybe I should get Tony Itoro on here in the next couple of weeks. I did
You
say, what
talk-
are you doing about it? And he said, I'm placing the orders now for a year
Yeah.
out. Scott, are you also, you can't do that because you're doing custom work, right? You can't pick the wolf for your client a year from now.
When we start talking with the client, we tell them you got to order your appliances now. So I mean, no, you're sitting there at an empty lot or you're about to demo a house and you need to order the appliances, and we'll be lucky if they show up.
Scott, we've talked about the supply chain a lot, and with you, and it was really bad. I know that you were waiting 12 months for a Sub-Zero at one point, et cetera, and you couldn't, and there were hinges and they were rationing them, et cetera. Is it getting better, or is it sustaining at just an incredibly horrible level?
It's shifting. And so, for example, I mean, some things are coming back and you don't have the same issues, but if you're trying to get electric service gear, can't find it. 6 weeks to 6 months in order to get gear, depending on what side you need. So people have finished houses and they can't run permanent electricity. In some places, garage doors, whole developments where it's like all the houses are just have plywood boarding up the garage doors, and the building inspectors have let them go ahead and do
Yeah,
it.
that was Toll Brothers. Like it was crazy.
And copper is right now, there's huge issues with sheet copper and getting that online. It's really with all the stuff that we're doing, it's urgency is one of our core values, and you order stuff fast.
Are designers substituting for the copper, for the Sub-Zero?
Only most of our design partners don't like to substitute. That's a compromise. That being said, that there are some compromises that occur. I mean, it does happen. Actually, a question for you, Jonathan, is one other element. I mean, there is very little doubt that for new construction, it has to almost happen at the high end, because otherwise the economics are just brutal.
Yeah.
More and more, and I think especially with the pandemic, there's people that now, that if they used to have one house, they now have two. If they used to have two, they might have 3 or 4 or 5. How is there any way to sort of peek into the market and see how much like having multiple houses has driven this, or is there a tracker for that?
So if there is, I have not been able to find it. I can, so my, my annual quest to get into the Urban Dictionary, the term I came up with during the pandemic was co-primary. And
Use that all the time. It's great.
Yeah, and I'm literally living off of the revenue that word is generating for me. But the idea is, that second home. And so I look at it, to answer your question, in the context of the Hamptons, which has become a co-primary market predominantly, instead of a second home vacation market. And so, the misnomer was people didn't sell Manhattan real estate to move out of the city during the pandemic. They just bought a second home, which became this alternative primary home or co-primary. And so there's strong evidence that second home markets are booming because they're not second home markets anymore. They're
Co-primary.
They're co-primary, exactly. And that skews higher in the sort of, the income strata, obviously.
It's affecting the retail in the Hamptons too, because places that would shut down for a season, they're staying open all year round.
And the workers can't live anywhere near the Hamptons, right? That's the other big issue.
Going in and out of the Hamptons from Mid-Island,
forget it.
Going there and coming out, it's incredible.
Yeah.
During the pandemic, I was out there coming into the city, and I would see, one day I spent like 3 minutes just counting all the pickup trucks. I mean, I was over 100 just driving down the highway in the opposite direction.
Yeah.
It's incredible.
But we have an issue that some clients say, it's like, look, I don't want to have to pay the Greenwich premium. And it's like, you're not paying a Greenwich premium. You're paying for the guy to drive the extra half hour to your house versus working someplace closer to home.
Exactly.
And somehow he's got to pay for the gas and his truck and his time and all of that. And that's, they're not just sticking it to you. It costs more to work in a luxury market.
Absolutely.
So what's the Fifth Avenue premium?
You have a New York City premium no matter what.
Right.
The building rules do not help that at all.
Yeah,
I'm sure.
So I just saw, I'm gonna hit share screen and say, and show you that the Toronto home prices dropped the most in in 2 years as rates slam market. Now, I'm sure if I was in Toronto, I'd be pretty nervous right now saying, oh my gosh, you know, Toronto home prices declined for the second straight month, are we in trouble here? What are some of the telltale signs that we might see in advance of a drop in prices? You have any advice as a chart watcher?
I think, like I teach market analysis at Columbia for the grad program. And the number one thing you look at is inventory. So inventory and sales activity leads price direction by about 1.5 years nationally, 1 to 2 years.
How about unemployment?
So there's two types of indicators, right? There's housing metrics themselves, and then there's everything else, right? And so interest rates are not a great metric for forecasting. Employment can be. Those are super macro and are less about nuanced changes in the short term, in my view, because the data's it lags way too much, and it's not as, there isn't the precision in it that, I don't know. I'm much more comfortable with, you can really look out 18 months based on the data you already have, and then the others.
I could not have predicted the New Canaan, Darien, Westport inventory levels a year out. Nobody could have predicted that we would see 200 houses in Darien go down to 30.
But that has been an extraordinary circumstance that got it to that place.
Yeah,
but even post-COVID, it hasn't suddenly we're not back to the new normal where we're back to 200, and nobody expects us to get back to 200 this decade.
Yeah, but the problem with that as a sort of a test case against that data is it's a freaking pandemic.
But post-pandemic, it's not loosening
No,
up.
but social, remote now never been a factor in the way that it is now. The fact that people stewed for 1.5 years or 2 years, brooding over how they hated their apartment or their home and they wanted something different, like all that stuff, like it was a sort of a one-off. I think it'll never be a one-off anymore. External stuff is, listen, I read, market studies, market analysis, and it is really, I don't know, to call it BS is like too extreme, but it has to be very specific, like property specific, then it makes sense. I think to say, hey, what's the future of Manhattan in 3 years, right? Versus what are the prospects for the specific development in 3 years? I think they're completely different scenarios. And the more specific you are, sort of draws you into, the type of data that you can rely on.
Yeah, it's very, especially here, it's so segmented.
Oh, yeah, it really is.
So the final question maybe is for Pete. He was asking it in the chat, but it's go ahead, Pete, on speculators.
So one of the things that we're seeing is that there are homes for sale, particularly in Florida, some around here. We're in New Canaan, and they're being bought sight unseen. It's almost as if there was a click to buy button on Zillow or something, and people are going ahead with it. We've had clients who are substantially wealthy who are missing out on properties because they can't get there fast enough.
Oh,
so just curious, like what the outlook on that is.
Yeah,
Do you think that continues?
Yeah, it continues until it doesn't. That's my sage advice. So yeah, I know a friend of mine has a home in Florida, $2 million, new construction. It's probably will be done in July or August. And they have people approaching them offering to pay 3.5 for it. And but they don't want to.
Why?
Because at least at this point, because they're renting a small house and they just want to get on with their life. They have small kids. You know, it's not always about the money, I guess. And actually, just to give you this is sort of the, maybe I'm diverging from what Pete's talking about, but when you think about, so one of my sons just bought a house in upstate Connecticut or upstate Fairfield County, and
When you're in Darien, that means New Canaan, right?
no, further upstate, because he's a police officer in Stanford.
Okay.
So he doesn't have the same income for New Canaan. But anyway, every house they went to was a, you know, it went to, you know, when
Multiple
it came on the
bids.
market, they saw that it came on the market and, you know, like 18 people made offers and they were the second or third highest and they could never win. So on the third or fourth time, he and I came up with a strategy. We were talking about it. And I said, just, you know, sort of pin down, see if you can meet the seller. I know you don't want to hear this, but see if you can meet the seller and say, what would it take for you not to list your house? And this guy said a number X over, and it was like 50,000 less than my son was ready to pay. And my son said, we can do that. They shook hands and the guy goes, thank God, because we were having a Super Bowl party on Sunday and all my friends are coming over and the last thing I want to do is show my house. And literally he left 50,000 on the table. The broker told him he was leaving 50,000 on the table. He said, I don't care. I'm selling it over what I'm asking. It's fair. And I want to watch the Super Bowl with all my friends and not have strangers traipsing my house. So that was worth 50 grand to them.
So Jonathan, I guess we'll close by saying, what are you doing in 10 minutes? You want to jump in my car and go look at that foreclosure with the barn and the 4.5 acres?
It
Such a
sounds pretty
deal.
good.
You should see his car.
Yeah.
What kind of car is it, John?
Oh yeah, well, it's a little two-seater, a little cute thing.
I could follow
see
you
it.
in my my Dodge Challenger with a V8 Hemi.
Muscle car.
Yeah, I think, but it's going to be, you know what, you're going to get there. Like a lot of people get there when they come out to see these houses that need work and they go, oh, I don't know. And so it's a big challenge if these houses need work. And I seem to
Because of the time,
have
because
a
of,
bunch of listings that need work. And that's the only
yeah,
reason.
supply chain, labor, all that
Yeah.
stuff is, I mean, that's what happens when you come out of a pandemic and there's an explosion in demand and half the people were laid off in the supply chain and you got to scramble, but you have the highest quit rate in history. And people aren't putting, you know, they have different standards now and wages have to be high, like everything sort of mentally has changed. So it's not just like, hey, I can't get this window. It's also like, I can't get an installer to put it in. And that, you know, that's a bigger problem or bigger challenge for housing to sort of power through. And I'm sure Scott sees that.
Jonathan, as I've said, for both real estate and for construction, it's the most miserable happy times ever. I mean,
Right.
so much out there, but to get anything done is just
Like, yeah,
Hands in the
and
gears.
it's, you know, I call this right now, for many people, it's money on paper. It's like, hey, my house is worth, you know, 50% more than I paid for it 7 years ago, but I can't find a house to buy, and I don't really want to sleep in a tent. So it's money on paper.
and forget about finding a house to buy. You can't find one to rent. I mean,
Right,
a couple
same
people
thing.
made the mistake of selling a house without having a place to go. And there's some panic things out there under
Yeah, yeah.
literally nowhere.
Well, this has been a great hour. Thank you, Jonathan. Thank you,
Jonathan,
Roberto,
thank you so
Scott.
much. Yes.
Oh yeah, my pleasure. It was great
we
having
want-
a nice
Do we
conversation.
want to end with a prediction? Does anybody want to make a prediction on what's going to happen to the market in the next year? I did hear 10%, but does anybody want to make their, I like your prediction of 10%. I see the Darien, New Canaan, Greenwich prices. I see them going up 10% in the next year. I don't see them doing 20, but it's not 5. So I like that.
Agree. Yeah.
And
I
in
mean,
Manhattan, I think for different reasons, you're going to see 10% because I don't think that they could build fast enough, and they are lagging the market, right? You guys can't build skyscrapers in 3 years, can you?
Yeah,
You
3
can't?
years.
Okay.
3 years?
For
Building it's the
Really
easy
cool.
part. Can you get it approved?
yeah, the approval part is.
Oh,
the
if you're going to
problem.
add all that, you got a long road.
Yeah.
So I see your inventory tightening in New York as well, too, because they're only now beginning.
Yeah,
to
but
market.
not, so I see it tightening. I just don't see it, like we're seeing it in the suburbs. I don't see it going down to, hardly anything, but I do see it coming down.
I mean, I think, Jonathan, I think your point earlier on, just sort of tying a couple things together, the market slowing down somewhat is really good because I mean, again,
You give inventory a chance to come on, right?
and that allows for people to change houses. Right now, you can't
Right.
make a
You're
transaction because you can't move with more.
We're locked in, as Roberto was saying, right?
Yeah.
Hey, Roberto, did you sell that 2-bedroom that you just put on like yesterday, the one on 11 West 69?
Not yet.
Second
but
showing next weekend.
Correct.
I'm going to
Scott's
check
a
back with you
great
next
student.
Thursday. I expect that to be gone.
I hear you.
Okay.
Yes, sir.
All right. Till next
All right,
week.
gentlemen, thank you so
everybody.
much.
Oh, you bet.
Appreciate it.
Take care.
Bye-bye.
And this recording will be on YouTube in a couple of hours.